What if I told you the way you've been thinking about taxes your entire life might be about to change? What if income tax, the deduction you see every time you open your paycheck, wasn't the main system anymore? Because right now, in 2026, we're watching a serious shift in how tax policy, tariffs, and investment strategy are being discussed at the highest levels. President Trump has publicly stated that tariff revenue, taxes collected on goods coming into the United States, could potentially reduce the country's reliance on income taxes. Now, whether that fully replaces income tax or not, that's a different conversation. The math matters. The numbers matter. And we're going to look at them calmly, clearly, and strategically. Here's what makes this moment important for you, not as a voter, not as a political commentator, but as an investor. In 2025, the federal government collected roughly $5.25 trillion in total tax revenue. Out of that, about $2.65 trillion came specifically from individual income taxes. Tariffs, on the other hand, brought in roughly $200 billion. That's a major difference in scale. At the same time, federal spending was around $7 trillion, meaning the government spent significantly more than it collected. These numbers aren't opinions. They're the financial backdrop shaping the policy environment we're in right now. And here's where it gets interesting for investors. Tax brackets for 2026 have been adjusted. Corporate tax rates are holding at 21% instead of increasing. Capital gains brackets have shifted slightly upward. Certain income categories, like tips and overtime under specific thresholds, are temporarily receiving different treatment. So whether you earn income from a paycheck, or from a portfolio, or from a business you own, the rules around money are evolving. And whenever tax structures shift, capital moves, markets react, corporate behavior adjusts, investment strategy changes. This video is not about taking sides. It's about understanding the numbers, like understanding the structure, and positioning yourself intelligently in a changing economic environment. Because in times of policy transition, the prepared investor doesn't panic, they adapt. And today, we're breaking down exactly what's happening in 2026, what the data actually shows, and what it means for you as an investor in the United States. All right, let's slow this down and really look at what's happening in 2026. Because there's a lot of noise, a lot of headlines, a lot of strong opinions. But as investors, we don't react to noise, we react to numbers. So first, let's ground this conversation in facts. According to the U.S. Treasury Department's 2025 annual financial report, total federal revenue last year came in around $525 trillion. Out of that amount, approximately $2.6 trillion to $2.7 trillion came specifically from individual income taxes. That makes income tax the single largest source of federal revenue right now. Now compare that to tariffs. Data released by the U.S. Customs and Border Protection, CBP, shows that tariff collections in 2025 were roughly around $200 billion, give or take, depending on trade flows and enforcement timing. Pause there. That's a major gap. Income taxes, roughly $2.6 trillion. Tariffs, roughly $200 billion. That's more than a 10-to-1 difference. Now, that doesn't mean tariffs aren't important. They absolutely are. But it gives you perspective on scale. Now let's talk about spending. According to the Congressional Budget Office, CBO projections for fiscal year 2025, total federal spending was approximately $7 trillion. That means the government spent significantly more than it collected, creating a deficit of nearly $2 trillion. Again, this isn't opinion. This is math. And when deficits exist, markets pay attention. Bond markets, interest rates, currency markets. Investors look at sustainability. They look at revenue stability. They look at policy direction. Earned income can go as high as 37% at the top bracket. Long-term investment gains, max 20%. That gap is not small. That gap is structural. And when tax systems create structural differences, capital moves toward the more efficient lane. Now here's where recent market behavior connects. Throughout late 2025 and into early 2026, financial media coverage from CNBC and Bloomberg Markets highlighted increased investor focus on long-term holdings rather than short-term speculation. Why? Because short-term gains, assets sold within 1 year, are taxed at ordinary income rates. Long-term gains, lower brackets. So investors are stretching their holding periods. That affects trading volume. It affects volatility. It affects sector leadership. Now let's move to corporate taxes, because this directly influences stock valuations. Under the current 2026 framework, corporate tax remains at 21%. That rate was originally reduced under earlier tax reforms and has now remained stable rather than increasing. Data confirmed by the Tax Foundation and corporate filings reported to the Securities and Exchange Commission, SEC, show that public companies continue modeling earnings based on that 21% federal rate. Why does that matter? Because corporate earnings drive stock prices. If corporate taxes had jumped to 35%, profit margins would shrink overnight. Lower margins, lower earnings per share. Lower earnings per share, pressure on valuations. But with corporate tax staying at 21%, companies maintain higher after-tax profits. And in theory, that supports dividend payments, stock buybacks, expansion, hiring, capital investment. Now let's zoom in further, because there were additional tax adjustments in 2026 that affect consumer cash flow. According to summaries released through official IRS bulletins and covered by financial outlets like the Wall Street Journal, several temporary adjustments include exclusion of tip income up to certain thresholds, adjusted overtime income treatment within defined limits, expanded standard deduction levels, senior tax benefit adjustments. What does that mean in plain English? For certain income brackets, households may keep slightly more take-home pay in 2026 compared to what would have happened if previous lower brackets expired. And when households keep more disposable income, consumer spending can strengthen. And when consumer spending strengthens, retail earnings, service sector earnings, and domestic demand metrics shift. Markets are forward-looking. Investors price expectations, not headlines. Now let's connect this to sector movement. In early 2026, analysts cited by Reuters Markets noted rotation into domestically focused industries, companies less exposed to international trade uncertainty and more reliant on U.S. consumer activity. Why? Because tariff uncertainty creates cost unpredictability for import-heavy businesses. But domestic-focused firms, utilities, infrastructure, local service providers, can become more stable under shifting trade policy. So here's the takeaway from Part 2. Long-term capital gains remain tax-advantaged relative to earned income. Corporate tax stability at 21% supports earnings projections. Inflation adjustments slightly expand tax brackets, impacting disposable income. Market behavior in 2026 reflects investors adapting to tax efficiency and policy stability. No speculation, no politics, just structure. And when you understand structure, you stop reacting emotionally to headlines. You start positioning strategically. All right, now we connect everything. We've covered the revenue structure. We've covered income tax brackets. We've covered capital gains and corporate taxes. Now the real investor question becomes, where is money flowing in 2026, and why? Because capital doesn't sit still. It moves toward efficiency. It moves toward stability. It moves toward opportunity. Let's start with interest rates and federal borrowing. Now let's bring this into 2026 specifically. The current income tax brackets, adjusted for inflation, remain structured across 7 tiers, ranging from 10% up to 37%. These updated brackets were released by the Internal Revenue Service, IRS, in late 2025 for the 2026 tax year. For example, 10% applies to income up to roughly $12,400 for single filers, 12% stretches to around $50,000, 22% moves past $100,000, and the top 37% rate applies to income above approximately $640,000. These are marginal rates, meaning you don't pay one flat rate on all income. You pay progressively as you move up brackets. That system is still in place. Now here's where things became more complicated in the recent market cycle. In 2025, new tariff measures were introduced under executive authority. However, in early 2026, certain aspects of those tariffs faced legal challenges. Coverage from the Wall Street Journal and Bloomberg reported that parts of the tariff framework were reviewed at the Supreme Court level, which created temporary uncertainty in trade policy. And when legal uncertainty enters trade policy, markets don't like it. Import-heavy sectors saw volatility, manufacturing stocks reacted, retailers adjusted forward guidance. You could literally see it reflected in market swings, especially in companies heavily dependent on global supply chains. Now, from an investor perspective, here's what matters. Tariff revenue is variable. It depends on import volume. It depends on trade relationships. It depends on enforcement. And it depends on court rulings. Income tax revenue, on the other hand, is tied to employment, wages, and economic output, which tend to be more predictable in aggregate. That's why, as of 2026, economists cited by Barron's and analysis published by the Tax Foundation indicate that while tariffs can contribute to federal revenue, replacing the entire income tax system with tariffs would require dramatically higher tariff rates, far beyond current levels. So where does that leave us? It leaves us in a transition moment. Income tax remains the backbone of federal revenue. Tariffs remain a policy tool and a growing revenue source, but not the primary driver yet. Federal spending continues to outpace revenue, and markets are responding accordingly. You've seen it in Treasury yields. You've seen it in equity sector rotation. You've seen it in investor positioning toward dividend-producing assets and defensive stocks. So, as an investor in 2026, your job isn't to predict political outcomes. Your job is to understand where revenue is actually coming from, where spending is actually going, and how that affects corporate earnings, consumer spending, and capital flows. Because taxes influence behavior, and behavior influences markets. That's the current landscape. All right, now that we understand the revenue backdrop, income taxes still leading, tariffs contributing but smaller in scale, let's shift the focus directly to you. Because this is where it gets practical. This is where it affects your brokerage account, your retirement account, your long-term wealth-building strategy. Let's start with investment tax rates in 2026. According to the Internal Revenue Service, IRS, 2026 Inflation Adjustments Release, long-term capital gains tax rates still sit at 3 levels: 0%, 15%, and 20%. Now pause, because this is important. If you hold an investment for more than 1 year before selling, you qualify for long-term capital gains treatment, and in 2026, you pay 0% on long-term capital gains if your taxable income is roughly under $49,000 as a single filer. You pay 15% if your income falls between roughly $49,000 and $545,000. And you pay 20% above that level. Those thresholds were adjusted upward for inflation, meaning investors can now earn slightly more before moving into the next bracket. That's confirmed by the IRS published updates for the 2026 tax year.